specifically gold and platinum. Gold has almost done 50% for the year. Gold is just not stopping, right? It's just running, and it's almost $4,000 an ounce, which is like an all-time high of note. I mean, if you were looking at the charts of the gold price going back to like the 60s, I mean, you just see it kind of flat, and then in this last 2 to 3 years, this massive spike, this exponential spike, right? And people are asking, we are asking, like, how much more, right? How much more? Nobody knows the answer, despite what everyone will tell you. But it is seen as a safe haven asset, given, you know, the volatility in the US. And
if you like the show, please give us a thumbs up, leave a comment, give us a like, and Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back to the Campus Dialogues, a Muslim Views production in affiliation with Muslim Fin Family Office. Muslim Fin Family Office, building trust, preserving wealth, empowering generations. And here to introduce, I'm your guest Ali Sali, and here to introduce our guest this evening, my good friend and colleague, as always, Siraj Buzik. Siraj.
Assalamu alaikum, Ali.
Wa alaikum salam wa rahmatullahi wa barakatuh. How are you?
Alhamdulillah, can't complain. Always good to be back in the studio.
Absolutely.
And like I always say on every episode, another week, another podcast. I'm Siraj, and tonight we have the distinct pleasure of welcoming back a guest we had on the previous podcast, Fawaz Fakir, a portfolio manager at Al Mutual ESG is no longer niche, it's mainstream. So the question for every Muslim investor becomes, how do we ride these waves without compromising our principles? Fawaz, a very warm welcome to the podcast.
thank you very much. Assalamu alaikum to all the guests. It's great to be back.
Fawaz, we're excited to have you back on the podcast. We had a good time the last time you were here, and you gave us some interesting insights into Shariah investing, etc. But I want to touch on something. In today's financial world, you know, it's rare to find someone who speaks both the language of Wall Street and the language of Sharia. Fawaz, you're one of those rare voices with credentials that span CFA, FRM, and CSAA. You're not just managing money, but you know, you're managing meaning. So I have to ask, how does this unique combination of technical finance and Sharia scholarship shape the way you build and manage investment portfolios at Al Mutual?
Yeah, thank you for the very flattering welcome. It never gets old. We were having a chat just before this podcast in the foyer, saying that it is a very unique space, blending, you know, my faith, blending values, blending morals into what I love, my passion, which is investments. And there's very few people that operate at that kind of junction, you know. And I am very blessed and grateful and don't take it by any means for granted. And, you know, we are very blessed in South Africa to have world-class functioning listed equity markets. We actually, our markets are world-class despite the size, you know, compared to developed market countries. The way we govern our markets, the way our companies are governed, the way our markets run, the transparency, the liquidity, etc. It really is at the highest level, you know. So to be able to bring Sharia finance and ESG investing, sustainable investing, and we're talking cutting edge Sharia finance and cutting edge sustainable investing that the global blue chip funds are doing in the States and into Europe, operating at that level within South Africa, given the sophistication of our markets, is, you know, it's really a blessing and a flag that I fly to the best of my ability, and a flag that's definitely going to be passed on, and industry and an area that's only going to grow and become more important as time goes on.
I mean, inshallah. And, you know, just talking about markets, Fawaz, you have decided to do a market update for us. So I think maybe you have a bit of a presentation for our audience tonight. So that's exciting. So maybe we can start there, and then we might interrupt you in between and, you know, have a few questions for you, if that's okay.
Great stuff. Yeah, it's an interesting time to be talking about markets, because what we normally do, we've actually entered Q4 or quarter 4 of the year today. It's the 1st of October. So Q3 is banked, the end of September. So what we normally do at this time of the year is we kind of take stock. It's a good time to take stock around how the year is going. We've got 3 quarters of the year behind us. So we often switch to kind of looking at the year to date, right? So that's the kind of stance I took for today's market update, where we look at our markets have played out, different elements of the market, which I'll touch on, very high level. But you can kind of see like what 2025 has been, and no one knows what the last 3 months has in store as always, but you know, you can kind of get a good picture as to what the year is about. So I've put together a couple of slides. You know, the first slide, we used to call the wall of worry, right? I named it macroeconomic landscape today because we have a few kind of keywords or buzzwords in it that investors love talking about, economists love talking about it, people love talking about it, right? And basically you have things like inflation, you know, always topical, interest rates, what's the Fed, what's the SARB doing? You have geopolitics. We have 2 wars going on at the moment, right? It affects markets enormously, right? We have Trump, you know, with a different story every day. The last podcast, the tariffs were very topical, still is. Maybe kind of lost a bit of heat now, but South Africa has a 30% tariff, you know, on exports to the US. We have this, what we're seeing globally is this delicate balance between all central banks trying to promote growth in all the countries, but also trying to kind of manage and keep inflation where it is. Inflation seems to be kind of in control, you know, it's not out of hand like it was. The central banks have managed to do a good job by pulling it back, but they're also obviously balancing stifling economic growth too much. So that's kind of where the world is in a nutshell, and they're doing a pretty good job. But what's very important here is that we are coming into a general cutting cycle where the central banks are cutting interest rates as a result. And over the next 2 to 3 years, consumers should have a bit more money or feel a bit more relief compared to like a year and a half ago when interest rates were peaking and everybody was struggling, you know. So that should be good for equity markets because people will spend. When people spend, companies make money, companies are profitable, and they give investors the returns that we seek in markets. So that's why, I mean, I think a lot of it gets lost in translation as to why do we always talk about economics? Why is the inflation important? Why is interest rates important? It gives you a good macro perspective on how we are doing as consumers and where we will spend our money. You know, when times are tough, we spend our money on the essentials, you know, your healthcare, your basic needs, etc. When times are better, which is kind of where we're moving into now in the next 2 to 3 years, we're going to start spending our money more on luxury goods and those that can afford luxury goods, more cyclical kind of companies. So those sectors should kind of do well. And you also, your emerging markets, your South Africas, your kind of more riskier countries that offer higher potential return in good times will start to do better than the US has done and Europe has done. So that's important. So I've changed the wall of worry because I was speaking to Siraj in the foyer again earlier about, you know, we always, as investors, we're always talking about risk and, you know, what are we missing? What's there to worry about? But we must also enjoy the good times, right? And we are seeing good markets at the moment, globally and locally. Markets are doing well. If we can go to the next slide. The last year was a good time to be invested in markets. So the JSE, to use a proxy for what the Johannesburg Stock Exchange has done in terms of shares, we use the JSE all share there, and it's done close to 30% for the year to date.
Amazing.
Which means that if you invested in the index or a rough basket of shares on the JSE, you would have made 30% on your capital for the year. That's a great return, right? That is a great return. So local markets are happy. We'll unpack that a bit more. The ACWI, which is the MSCI All Country World, that's like a proxy for global markets in USD terms, has done 17%. That's a good return for the year. Remember, it's not even a full year we're talking about. But the rand is also strengthened this year. if you think back a couple of months, maybe back to last year, the dollar showed enormous strength against all currencies. The rand and other major currencies have pulled back a bit this year. The rand's up about 9% on the dollar. I mean, the rand will generally depreciate against the dollar over the long term, but this year it's clawed back 9%, which means that if you look at global markets and you take the rand appreciation into account, so you look at the ACWI and you take rand appreciation into account, you actually want the rand to depreciate if you invested in global companies, right? Because that will inflate your return. Then global markets have only returned around 9%. Call it, my maths there, about 8%. So look at that dispersion, about 8% globally. If you chose to go global with all your money, you would have gotten 8%, versus almost 30% if you made a local decision and said, I'm going to keep my money locally on the South African markets. Right? So there's a big dispersion there, right? Yeah. But the JSE all-share return of 30% doesn't tell the full story. Yes, that's what the index has done, but it wasn't all roses for all the companies. It's almost single-handedly been driven by metals, specifically gold and platinum. Gold has almost done 50% for the year. Gold is just not stopping, right? It's just running, and it's almost $4,000 an ounce, which is like an all-time high of note. I mean, if you were looking at the charts of the gold price going back to like the 60s, I mean, you just see it kind of flat, and then in this last 2 to 3 years, this massive spike, this exponential spike, right? And people are asking, we are asking, like, how much more, right? How much more? Nobody knows the answer, despite what everyone will tell you. But it is seen as a safe haven asset, given, you know, the volatility in the US and what's going on in the world, etc. People still find gold as a safe haven. We are the biggest producer of gold, right? So foreign investors flock to our gold companies, of which we have many, and they drove that price. Gold has done, that's the gold price. Some of the gold companies have more than doubled this year on the JSE. Platinum, even more of an amazing story. The platinum price has done almost 80%. You know, some amazing. Platinum companies have done 140% for the year. So it's this platinum, call it PGM, platinum group metals and gold, that has been run really hard. Obviously, the companies that produce these things are linked to the prices of these things, and you know, and it's not been that kind of rosy for your normal industrials, or your what we call industrials, which is broad, which is like South African incorporated type businesses, your retailers, all your other stuff basically that we know. Financials also have been fairly flat. Obviously, on the Shariah side, we can't touch the financials, but on the sustainable ESG funds, we can. So it's been a year where you really had to be in the right places, invested in the right places to make money, or to generate alpha, as we call it, to outperform our benchmarks. And that decision as to where you invested, whether you chose to be locally invested, where on the JSE, which sectors were you invested in, resources, financials, industrials, versus how much of your money have you kept local and how much have you put offshore. And then lastly, a lot of viewers want to know always, like, the Magnificent Seven. What's the Magnificent Seven done? You know, it's the Magnificent Seven, the top 7 biggest tech companies in the world, has almost single-handedly been driving global markets, or the US market, over the last kind of 2 to 3 years. Yeah. But this year, it's done a mere 20%, call it, which means that it hasn't been carrying this. I mean, it's kind of on par with the all-country world index, which means there's not a dominant effect of these companies holding the global markets up anymore. It's kind of tapered down and pulled back, you know. So yeah, that's a general overview. Next slide. Over the last year, I mean, I've covered a lot of this. The JSE's done almost 30%. Gold, Plat's up heavily. The rand strengthened, it's pulled back about 9% on the dollar, very important. But the MSCI all-country world or global markets have lagged South African equities significantly, right? So it's I'm highlighting this because it's not often that you see the magnitude of this dispersion. If I were to quantify the magnitude between investing locally and globally, it's over 20%.
Okay.
That's your kind of opportunity cost, right? If we go into the equities analysis slide.
And obviously,
yeah.
for us, just to stop you there for one moment. Obviously, that hasn't been the case over the last, let's say, 2 or 3 years or so, because it's always been that although there was a lot of value in the JSE in the South African market, shares weren't necessarily performing as well, and you got those returns from the Magnificent Seven if you were just in the S&P 500. So I think that's also the reason why you are highlighting this, because it's an anomaly in a sense.
Correct.
Right? Yeah.
Correct. No, absolutely spot on.
Yeah.
I mean, just on that, I was looking at the kind of the price to earnings ratio of global markets and the price to earnings ratio of the JSE. And what the price to earnings ratio is, it's the most widely used, for the viewers, the most widely used financial kind of metric out there to analyze a stock. It basically tells you how many years will it take back to in earnings, how many years in earnings will it take to pay you back kind of for your investment. So the global markets in general, the all country world, is at 22 times earnings, which means it'll take you roughly 22 years to get your investment back in company earnings. The JSE is at 11 years only, which means it's more than double or more than half of the payback period if you invest locally. So it's absolute no-brainer in terms of how cheap South African equities are. Mm-hmm. Whether that plays out in the market is a different thing, but it has to mean revert at some time. People see value in it. There's just a whole lot of other variables at play: the risk on, risk off. How much currency fluctuations do invest foreign investors can they do they have appetite for, etc. So it's really other factors in play. It's not the does South African equities offer value question.
Correct.
I mean, I have 2 slides on gold and platinum, but we can skip over that. We can go to the macro environment slide.
Just on gold and platinum. So,
yes.
This is a Muslim Family Office podcast, and our clients like gold, the sunnah money. So maybe just give us a bit of insight into what your thoughts are around this, the price increase in the price of gold itself. What is it about gold that is now being seen as a store of value, where many portfolio managers in the past would scoff at gold almost in a sense and say, no ways, we're not putting gold in our portfolios. And now everybody's sitting back and saying, well, maybe we should have added that in, or, are we glad that we did put in that 5%,
Yeah. No, that's a very good point. Gold has traditionally been seen as a safe store of value, but what's happened with gold, I mean, think about it practically, it's become less, it's gotten less utility value over time. I mean, the only use I can think of for gold is jewelry, right, as a status kind of icon. But in terms of its utility value, when you compare it to any other metal like platinum, which is widely used in the car production or the auto industry, it has very little utility value, but it's still seen as people have consensus that it's seen as it's a physical store of, it's a kind of a safe haven, a physical store of value. And whatever people deem as value, and there's enough consensus, I mean, we see it with cryptocurrency now at the moment, if enough people have consensus that it's a store of value, then that's factual, But what backs that up is central banks around the world have been buying gold in copious amounts, right? And that's why you see this demand for gold and the gold price also shooting up, because there's big money behind it, besides the retail investor and the family offices, etc., and the man on the street. There's been huge sovereign and institutional inflow behind this safe haven, in volatile times. So it's an interesting story. I think often around how much higher it can go and why. and I'm sure a lot of the viewers also wonder the same thing, because it's no longer deemed as, no one's sitting with physical gold in their houses or in the store anymore. It's all done via exchanges and digitally these days, But that physical gold in Sharia finance has to exist somewhere. It has to be stored somewhere. It has to be transparent, measurable, and be able to be located for it to be Sharia compliant.
Interesting.
Yeah, for once, perhaps just to latch on to Ali's question, look, gold, it's breaking records. But in Islamic finance, gold isn't just another asset, it's ribawi. It raises a fascinating question. How does the traditional view translate into a compliant investment in modern gold mining companies? And what has been the driver for the inclusion in a strong performing portfolio, this year?
Yeah, so it might be worth noting gold over the long term is not a very lucrative asset class, right? I think the last time I looked at what gold's done over the period of a few decades, maybe 30 to 50 years, you're getting around 10%, maybe 12% per annum in gold, and general equity markets do more than that over time. But yeah, it's from a Sharia compliant perspective. Just to bring that in, I mean, we touched on it on the previous podcast, but just for the viewers as well, for gold companies to be Sharia compliant, it has to pass the 2 tests, right? And that is the very nature of a gold mining company has to be halal, which it is. Our mining companies are halal. There's nothing wrong with mining resources out of the ground, and by way of adding value through the extraction and filtration process, and I'm no mining expert, and selling it off is a halal way of conducting business. So it ticks that box. Secondly, it's the interest to the riba box it has to tick. And these mining companies cannot be highly leveraged, or they can't use excess debt on their books in the way of conducting the business. And most of our gold miners tick that box as well. So gold, Sharia indices and Sharia funds hold lots of gold compared to conventional funds. Contributed to that as well is that you cannot hold any financials in South Africa, which is a substantial portion of the market. So naturally, by stripping away, call it maybe a third of the market, you're left with this 2/3 or 65, 66%. And naturally, then gold and plats and resources is going to be upweighted. So just by that construct alone, Sharia funds are resource heavy and gold heavy and plats heavy in general. I say in general because obviously Sharia funds can take a view against gold, deeming that it's too expensive or not profitable at any point in time. But in general, structurally, they should be more overweight than the average equity fund.
And if you were to compare a Sharia, let's say, balance fund that had exposure to gold versus a conventional balance fund, and I'm not trying to, because obviously each portfolio manager has their own view, and they'll have their own picks and the underlying shares that they have within their portfolios, or asset classes that they have within their portfolios. But I mean, maybe from your experience, have you seen that gold has made a difference within the Sharia portfolios? Have you noticed that?
Yes, absolutely. We do diligent, what we call attribution, in terms of these are returns. This is our funds return every month, or we look at it every day actually. And this is what the benchmark's return has been. Our main objective is to outperform our benchmarks and generate wealth for investors. So we are able to tell you exactly where our returns are coming from, right? And absolutely, gold and plats have contributed well, given the returns that it's generated. But at the same time, a lot of the industrial counters that align with our philosophy of holding high-quality companies and very profitable companies at the right price have not done that well. So especially in the last year now that the metals have run, and while we know they outperform over the long term, over 5 years, 3 to 5 years and longer, it's not particularly done well in this period. It's almost as if these quality companies in the industrial space, your retailers, your vehicle sales companies have given up their returns to the miners for this. But this is markets.
Yes.
It's the cyclical nature of markets, and it doesn't mean that it's not a good investment. Doesn't mean that we're selling out of the companies that haven't done well and buying the companies that have done well. But we believe in our investment view, and that if you hold good quality companies, including your gold miners and your plat miners throughout the cycle, that you'll generate good returns.
Absolutely.
Yeah, so we can go to the macro environment slide just very quickly there. I mean, a lot of these things we've touched on in our questions and in the intro. But basically, I think I touched on this as well, is central banks, including the South African Reserve Bank, have seemed to be managing inflation quite well with their interest rates. And things seem well balanced, right? I believe it's a good time to be invested. It has been a good time. I mean, we have perfect hindsight, but I believe that it's always a good time to be invested. But things are going to get better over the next 2 to 3 years. The consumers should have, if there's no catastrophes or disasters, consumers should have more money in their pockets. We should spend more. Companies should be more profitable.
For us, just on this piece, so when we look at interest rates going down, even in the Sharia compliance space, our benchmarks are still linked to interest rates, right? Even though our clients earn profit share, right? So the contracts are set up differently. Profit share is earned instead of interest, and there's a big difference between the two. However, to make sure that it's fair to investors or Sharia-compliant investors or people who are banking from a Sharia-compliant perspective, there has to be a benchmark. And so, to make sure that those returns are somewhat similar, people end up earning this profit share. But now what's happening is interest rates are going down. The Federal Reserve has cut rates. They're more than likely going to cut rates again. Normally what ends up happening is the SARB follows the Federal Reserve, well, the world follows the Federal Reserve. And so internationally, you're going to see interest rates coming down. Now, in our case, some of our clients are high net worth clients. They have large sums of money sitting in, income generating funds, or in certain cases, in cash, right? Are we saying now, with where markets are going, this might be a good time for them to start looking at that cash holdings and say, well, maybe we need to start making an investment decision?
Yeah. You touch on very, very important points. I mean, what we do know, as you mentioned, is that interest rates are going to come down, or have been coming down, and are likely to continue coming down. So that means you are going to earn a lower rate on your fixed income type Islamic investments and vanilla investments, right, going forward. And what normally happens when you have perfect hindsight and you look at these cycles through time is this is the time that you want to get out of your fixed income, which is going to return lower yields and lower returns, and more into equity markets, because equity markets are going to give you a higher return. And we're generalizing it, right? It might not have been the case in every cycle, but this is the general. I mean, like I mentioned, we're going to be spending more. Companies are going to be more profitable. That will be reflected in equity prices. You want to ideally, if you invested for the medium to longer term, you want to be shifting your money from your cash-focused, income-focused, more into your companies and listed equity type markets now, and you should do better given history, where history is. Yeah, so I think we've covered a lot of the macro environment points. Yeah, we still have struggles in South Africa. We still have unemployment, income inequality, very specific things we grapple with in South Africa. That remind us that we are still an emerging market or developing market, that our feds and our government has to balance. But basically, things seem to be plodding along. company earnings have not been that great in South Africa. Besides if you take the resources sector out of it, it's been kind of like subdued. It's been positive, which is good. I mean, it's not negative, but it's not been shooting the lights out. It's a function of, you know, where we were in the economic cycle. Interest rates have been high. People have been struggling. People are struggling, and that is also reflected in company profits and stuff. But like I say, if the South African Reserve Bank does their job properly, and things should become a little bit easier for the general consumer. Moving on to, I put a nice kind of chart on slide 9 where we look at, I mean, I referred a lot to the market cycle, right? And we divide the market cycles up into 4 phases, right? Namely, recovery, overheat, recession, and reflation. And we've been in a recessionary environment for a long time, meaning like that's the worst times. I think times are tough. Markets are not happy. People have been saying markets shouldn't be happy. Interest rates are sky high, inflation sky high, the consumer's struggling. But it follows a natural path, you know. Recession moves into reflation where things are becoming good again, you know, like we've been talking about. And then eventually into recovery where things are all, you know, rivers of milk and honey. And then it gets too hot into the overheat cycle, and then boom, markets come down again, interest rates go up. There's a squeeze on consumer spending. And this is the natural kind of, people name it different things, but these are kind of consensus for kind of cycles that markets can be in. But the important thing is we have been in a recessionary environment for a long time and starting to move into reflation. Things are getting better, but there's been a kind of a detraction back into recession, which means that, you know, it's kind of not confident that we're going into good times. And what we use here is different proxies for leading economic indicators. So here they use US production manufacturing index, which is an indication of, you know, how many orders manufacturing concerns are putting in, you know, in terms of how do they view business in the future, services firms in terms of how, you know, what their forecasts are, etc. Like, it's just a good dipstick and a widely used dipstick for are there good times ahead or are businesses struggling? So we use that as a kind of a basket or a proxy for where we are in these cycles. And the key takeaway is that we're not squarely going into a recovery based on the economic data just yet. There's a bit of wheel spinning, you know, given this balancing act that all central banks are playing. So that's just something to be aware of. And yeah, I think in my conclusion, just to reiterate a lot of what we've been talking about, gold and platinum has been driving local equity strength. We've said that a lot today. Equities markets have been good, but the dispersion between sectors and whether you went local or global and where you went, especially with countries as well, where you invested your money mattered, right? Your opportunity costs are high. If you got the call wrong. So active selection, especially for us that invest professionally, you see kind of big dispersions in returns. If you look at across all the managers, every month this year has been like huge dispersions. It's been interesting, and we get the popcorn ready every month when the managers publish their returns. And then rand volatility. The ZAR is not one of the strongest currencies in the world. Right? We are an emerging market, and it's a concern for foreign investors. And we'll really start seeing money flow into our general equity stocks when investors have more confidence that, you know, there's more confidence in the rand, and when there's a bit less risk globally, then we'll see a really big move like foreign direct investment. And the Fed, what the Fed does and what the dollar's doing remains like the most important thing, one of the most important things in markets.
For us, on the rand volatility that you mentioned, it is a real concern. But for Muslim investors, hedging isn't straightforward, right? So, we have to avoid gharar and riba. So what's the compliant path forward? What are the available instruments or strategies to hedge against currency risk in a Sharia-compliant way?
The best way is to invest in hard currency, to take your money offshore and you get exposure to, your USDs and your stronger currencies. We find that a lot of, and Ali, you'll experience a lot of this, and you have experienced, and you, Siraj, you guys have experienced that the South African high net worth Muslim investor has a massive amount of their wealth concentrated in their businesses and in property.
Yeah.
In those two things. And
it's all exposed to the rand.
And it's all rand exposure, 100%.
Yeah.
And, even if you take just a bit of that wealth and put it offshore in blue chip companies like in a global Islamic fund, you might not be getting the returns every single year that your business is generating if your business is profitable, inshallah. But you're going to get a diversified and a distinct source of return, which is so important. I mean, you can't put all your eggs in one basket.
Yeah.
Diversification is the one free lunch that we have. It's the one option we have to be taking. And it's difficult, it's a psychological thing as well. We feel that if we buy physical property, we can walk in it and we can renovate it and it's there and it gives us comfort. We feel like in our businesses, we have control of the outcomes. We have control of how we treat our staff, how much goods we manufacture. It's a control, and it's a comfort and a control thing. And I mean, the more education we can put out there in terms of how important diversification is, and that the returns are good. The global returns are good. Everyone will be better off for it. In the investing.
Diversification is your only free lunch, Siraj.
I like
you
that.
hear that? I like that
That's
too.
a t-shirt print, right?
No, but really it is. And when it comes to asset allocation, whenever we advise our clients, normally what we say is when we look at the kind of makeup of a client's portfolio, at least, and this is including property and their businesses and the entire world, 25%. At least 20 to 25% needs to be exposed to other geographical locations. Now, it doesn't only need to be in the US, but other geographical locations. You need to have that diversification because, you don't want your eggs in one basket, really. We hear about it all the time. Yeah. People losing, massive amounts of wealth that you've built up your entire life. So it's about wealth preservation. Yeah. And if you want to preserve wealth, diversification is key, But for us, shukran for that. I think that was powerful. That slide, one of the circular one with the 4 quadrants, super powerful and really drove home how cyclical markets really are. Yeah. But one thing I wanted to touch on with you, and having you at the Muslim Fund podcast is always such it's so inspiring because not only are you dealing with Sharia-compliant investments, but you're also doing it in a ethical, from a social and a governance, perspective. The ESG, the buzzword. It's not really a buzzword anymore.
It's mainstream.
It's mainstream now. Yeah. So I think it's important for our clients because as we see the youth now coming up, making large sums of wealth, and really wanting to invest their wealth in a ethical way, in a good way, and see it grow from and make a difference in the world. Here's an opportunity for them to do that. So again, I think we did touch on this in the last podcast, but really, where is the intersection between ESG funds and Sharia-compliant investments?
Yeah, you make a good point there that, it's very important to note, like you say, that wealth is moving down, into obviously younger people are getting older and the generational wealth is being passed down now into kind of the millennial bucket. And the millennials and younger are a lot more open to investing and diversifying and investing with financial institutions instead of their own businesses and property. So that's good news for the industry, that, you know, there's a lot more trust, I guess, in financial institutions and equity markets. The question with regard to the intersection between, you know, sustainable or ESG investing, we can use the terms interchangeably, and Sharia investing is a fascinating one in that, you know, there's so many similarities between the two. I mean, every day I see a different angle of how similar sustainable investing or ESG investing is to Sharia principles, you know. In fact, there's hardly any differences. Just for the listeners, ESG is an acronym for environment, social, and governance, right? Which is basically environment you can use as a proxy for the planet. How do we care? Do we look after the planet in the way that we should? It's both a Sharia concept as well. Social is, are we good to the people? Are we good to each other, you know, in our business dealings and the way we deal with each other? And governance is business conducted in a good way, in an ethical manner. So it spans almost these three buckets of goodness that we're trying to promote, right? And it's not an investing thing, it's not a financing thing, as you say, it's in all industries in all over the world, right? Wherever you look, everyone's trying to do their bit for the people or the planet, whether it's a marketing thing in some industries or some products, that's up for debate. But the key message is that we have to move in the right direction of goodness. And when you move in the right direction of goodness, you fall squarely in Islamic principles that has been cast in stone for almost 1,500 years, you know. And every day, like I mentioned, I see a new angle of similarity. In fact, the only big differences are ESG or sustainable funds don't push the interest or the riba narrative, because that's a squarely Islamic concept. And on the ESG side, they push the kind of decarbonization theme quite hard, which is you know, investing in kind of lower carbon footprint companies, which Sharia financing has not completely gotten there yet, but it will catch up when the scholars and we find a practical way of doing it from a Sharia perspective, because we are harming the planet, you know, if we carry on the same way that we've been carrying on conducting business, etc. And I'm yet to see the Sharia kind of a practical implementation of carbon emissions. Obviously, a lot of Muslim countries, especially in the Middle East, have been big on oil and gas and natural resources, etc. So that plays into that theme as well. You know?
Yeah, absolutely.
It's for us, some say Sharia is the superset of ESG. That if a company passes the Sharia screening, it must be ethical by default. But is that always true in practice? I mean, do you find that this to be true to your analysis, or are there cases where a compliant company might have poor ESG metrics?
Yeah, so we do see in the Sharia investing pool that pool of companies that we can invest in from a Sharia perspective has high ESG credentials, right? If you think of each company we can invest in having a ESG score, let's call it an ESG score out of 10, and you look at the aggregate of that Sharia pool that we can invest in, it's well north of 6.5 to almost 7 out of 10, which is way above the average of 5. So it lends itself to a highly rated ESG, or a high rating of ESG, and a highly sustainable kind of pot as a starting point. But then just to crystallize that also, there's a number of sectors in there that, your alcohol, tobacco, gambling, weapons manufacturing, etc., are completely removed from both ESG and Sharia. So you almost toss that out and you say this is uninvestable from the start due to the very nature of the business. And what you're left with there is then a pot of industries that are kind of better for the people and the planet as a starting point as well. So that contributes to that higher ESG rating, or better, more sustainable pot of companies to invest in.
I see that you also have a couple of slides on ESG, and I noticed that you had the one on the intersection of the Sharia and ESG. So maybe we can just put that slide up.
Correct.
Which one was that?
It was the second last slide. Slide 16. Yeah, that shows it quite nicely.
Yeah.
Where you have this, I mean, I mentioned it now, like alcohol, adult entertainment, gambling, tobacco, weapons manufacturing, that, you know, world-class ESG funds and Sharia funds all over the world exclude those sectors. Companies that are involved in those sectors are uninvestable, essentially. And you're left with kind of the big things, like I mentioned, is ESG as a decarbonization theme to it, often with a lower carbon footprint, and your Sharia, obviously, very importantly, from an interest perspective. You know, you're not inventing. There's poor products and stuff, but they make up kind of a small portion. The main thing is interest, and that strips out kind of your entire financial, all your banks, etc., your insurers, etc. A lot of property stocks as well, excluded from the investable universe due to its high leverage that they use. Those are the two big things.
On the weapons portion, is that always clear cut? Because in certain cases, you know, weapons are for protection, and then in other cases, weapons are for harming people. You know.
Yeah.
So I think that one, does it become a bit?
You can see why, absolutely why it can be a grey area in terms of the interpretation of the use of weapons. But I mean, we look at the revenues that companies generate just from weapons manufacturing, irrespective of who they're selling those weapons to, who their clients are, and just to avoid any conflict or any dispute, strip those companies out.
Okay. Very interesting. Fawaz, shukran again for your time. We appreciate you so much. I think we're going way over time. This is a bit longer than what we used to in terms of the podcast, but I'm sure that the audience found this very interesting and they're glued to their seats right now. Siraj, is there anything you wanted to add?
I think the only thing to add is we need to have a part 2.
Yeah.
So we'll probably invite you back for us. But Jazakallah, shukran so much for your time. It's always a pleasure having you on the podcast. And again, we'll hope to see you soon again, inshallah.
Shukran, and thank you guys. It's been amazing as always. Appreciate it.
And there you have it, guys. If you like the show, please give us a thumbs up, leave a comment, give us a like, and assalamu alaikum wa rahmatullahi wa barakatuh.